Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. Australia is still in the midst of a housing crisis. House prices have risen for 15 consecutive months. Rents are soaring. Demand is outstripping supply. Today, I wanted to look at one possible solution to help ease the housing crisis. Could private credit make a real difference? Remember, this is general information only, and you should always seek professional advice before making investment decisions. Alan Greenstein is the Chief Executive Officer and co-founder of Zagga, an Australian boutique investment manager and non-bank lender, and a great supporter of this podcast. Alan, welcome back to Fear and Greed.
Thank you, Sean. Nice to be here again.
We're talking much more about private credit nowadays as banks become much more particular about who they lend to. Has private credit in Australia, I get the potential for it. Previously, has it ever really been a big part of the residential landscape historically?
Sean, I think private credit has been around, ever since people first started lending money to one another. There's always been, let's just call it a grey market where privateers have operated. But certainly over the last 2 decades, private credit has emerged from the murky background and has become much more acceptable on the forefront. That's not to say that over the last couple of decades it wasn't still considered to be lender of last resort type lending. In other words, you were unable to get the money from anywhere else, so you went to a privateer, and as a result of that, you were considered to be high risk and you paid a lot of money. I would say that certainly since the GFC and more particularly since COVID, private credit has not only become an accepted part of the funding waterfall, but that many of the private credit operators today are really highly credible, highly competent, and highly effective as what they do. And I would imagine that a number of borrowers now see private credit as being their first port of call for finance before they go to the bank. So private credit has definitely grown enormously, and I think it's here to stay and also here to grow. And that's not only the case across the world. I mean, in Australia, we're beginning, to see that private credit is about 10% of the market right now. That's forecast to grow to about 25% of the market in the next 4 to 5 years, which means that 1 out of every 4 deals will be a private credit deal. But in the US, this is already at about 50% of the market. So it can only grow.
And the point there is when it becomes it is now an accepted asset class in a sense on both sides of the equation for investors and also for borrowers. But that also, perhaps not so good for the middlemen, but it actually makes it a more competitive market, which is actually, again, better for both sides of the market.
Yeah, absolutely right. I think the critical thing about competition and about it being competitive, private credit is definitely a low barrier to entry market, especially if you're in the non-regulated market, if you're on the commercial side. Obviously, if you're lending to individuals in respect of their own residential properties, you've got to deal with all of the credit, they're regulated loans, but the large majority of the privateers are not at that end of the market. And eventually, therefore, being a lender is not hard to do. So I guess it really comes down to the quality of the lender and the quality of the borrower, and that determines the quality of the investment. So from an investor's point of view, I think you've got to look very closely at the counterparties. From a borrower's point of view, you've got to make sure you're getting the money from a credible lender because you want to make sure the money's going to be there when you need it.
Okay, so let's talk about the housing crunch that's going on now and how private credit can help. Where do we stand with that? I outlined what's going on in the housing market, and we all kind of know the story very well. How can private credit help?
That's a good question, Sean. And I think the way private credit really helps right now from a developer point of view is that there's an almost insatiable appetite for residential type development in Australia today. I think as we all understand, we've got huge immigration. The population is growing. We've got an influx of people. Our large metropolitan areas are not getting smaller, they're getting bigger. The metropolitan boundaries, Greater Sydney, Greater Melbourne, Greater Brisbane, etc., are all extending now. They're becoming wider and wider, and more people need to be accommodated. We're going to take in about 250,000 extra people a year for the next 4 or 5 years, according to the Immigration Department, to equalize the skill shortage. And all of these people need somewhere to live. Now, when you need somewhere to live, you also need somewhere to go to school. You need somewhere to shop. you need somewhere to park, you need somewhere where your healthcare needs can be satisfied, you need somewhere to pray, etc., etc., etc. So the housing market has a massive knock-on effect on all of the other things that need to be built. Now, that's on the one side. That's where the demand is coming from. The traditional funders of this have been the banks, and the banks have really got two problems. Through no fault of their own, they've got massive regulatory and prudential risk issues which they need to deal with, and that generally makes them unwilling participants in certain types of lending, or more particularly creates restrictive lending practices for them. They cannot be as agile and commercial, as entrepreneurial as, say, a privateer can be. And secondly, banks have to operate within very, very strict and finite credit criteria, and those don't always suit the market. And generally, the banks are a couple of steps behind the market. So today, if a developer wants to put something up that is not 100% within the bank's credit specs, the developer is going to have a real difficulty finding the money for that. Now, to a developer, time is money. The quicker they get this thing out the ground, the quicker they're going to get their return. So developers have started looking for alternative sources of finance. And the private credit market has been there to provide that alternative source of finance. Now, as developers have come to private credit more and more, so private credit has grown, and that's really how the market has grown. Now, speaking only for Zagga, I can't speak for others, but if we speak to the kind of developers that we're currently funding, they are all clients of the large banks. They come to us because we're able to do the deal quicker for them, and we're a little bit more flexible. It's not to say we compromise on our credit in any shape or form. In fact, I'd like to believe that our credit is as robust, if not more robust, than the banks. But because we don't have these gargantuan structures, we're able to turn this around a lot more quickly, and we're able to be a bit more flexible on pre-sales, on other kinds of conditions, etc., to make it worth the borrower's while. The quid pro quo for that is the borrower's got to pay a bit more money, and the advantage then to the investors, they're going to get a better return than if they leave their money sitting in a deposit account or a term account. And that's really how the cycle is working.
Stay with me, Alan. We'll be back in a minute. I'm speaking to Alan Greenstein, CEO and co-founder of Zagga. I suppose you're relying on the fact, particularly in residential, people repay loans. That's the great thing about property.
Yeah, I think, Sean, what's important to understand there is that most of the private credit operators are not funding the individual owner at the end of the day. Yeah. The banks are still very much in that market. We are funding the developer who's building the unit.
Yeah.
But I guess just to take your point, what we have seen over the last 4 or 5 years, and what maybe we would have expected to see, but what we haven't seen, is pre-sales are still holding up. So to the extent that developers have pre-sold units, the market is strong. People who have paid for their units are not letting those units go, even if the development is taking longer, because property prices have gone up. So the banks are still funding the end user, but that is allowing cash to churn through the system and for the developers to be able to repay their loans to the private credit lenders.
Okay, so on the investor side with Zagga, who are your investors primarily?
So from a Zagga point of view, and I would say this is true for most of us in the market, we have a range of investors ranging from high net worth individuals, including self-managed super fund trustees, to family offices, to smaller institutions. We at Zagga have a number of smaller institutions who also fund our loans, whereas some of the other players are much bigger than us, and they would have much larger institutions, including sovereign wealth funds. But I guess the point that you're making and that I'm making is that the investor population for private credit ranges from the single high net worth individual sophisticated investor all the way through to the large financial institution. And many of them are foreign. Some of the statistics that are coming out today suggest that foreign investment will make up about 48% of the market over the next 5 years, which would have kind of quadrupled over what it was 2 decades ago. So we're seeing a lot of foreign interest.
Okay, and so when we talked about residential then and lending to developers, what else does Zagga do? What other areas are you lending to?
So from Zagga's point of view, our model is quite simple. We will lend for any legal business purpose or any legal loan purpose. provided that we can get first mortgage security over the property. So not every single one of our loans is for a property purpose, i.e. a development.
Yep.
We could be funding a management buyout. We could be funding the purchase of stock. We could be funding some other business purpose, cash flow funding. The first deal we actually did was a buyout of one partner over the other. But provided we have a real property security, i.e. a first mortgage over property, together with any of the other guarantees that we need based on the actual credit assessment that we do of that deal, we can just about fund any loan purpose that lends itself to that type of security structure.
You've sort of answered this question earlier on, but where does private credit go? So with that as background, that's the kind of thing that Zagga and others are providing money for. What do you think the landscape looks like in 10 years' time in terms of someone looking for finance?
Okay, let's talk about it from a finance point of view, and then if you don't mind, I may talk about it from an investment point of view.
Yep.
I think in terms of somebody looking for finance, the market is going to grow because as private credit grows into the market and attracts more market share, it itself becomes more sophisticated. It is able to fund larger loan sizes. It becomes more accepted as an acceptable part of the funding waterfall. And as I said earlier, if the American and the European experience is anything to go by, and the trend that we're currently seeing in Australia remains on trend and is indicative of something coming, then this market is going to grow to being about 25% of the total lending market in Australia for commercial real estate debt. That's not the total market, the commercial real estate debt market. So that part of it is going to go. Mm-hmm. I'm not specifically talking about unsecured business finance or those kinds of things. I'm not in that market and I don't understand it well enough. Yep. But I see no reason why that shouldn't continue to increase either. So fundamentally, I believe private credit will continue to grow. The two aspects of that will be the banks will continue to become less efficient, not more efficient. The banks will naturally go to the bigger, larger, more complex transactions, and the middle part of the market will get taken up by the private operators. So over 10 years, I think it can only increase. Just to be able to talk from an investment point of view, I think that what's important and what we haven't really spoken about is why are investors funding private credit? And the simple result is returns. Investors are now earning between 8 and 10%, maybe even more, for something that is a reasonably safe, secure, but very transparent, very consistent, and very non-correlated return. So if I've lent into the private credit market, if I've put money into a 1 year or 18-month deal at a 65 or 66% loan to value ratio, and it's paying me 9 or 9.5% per annum, that is not going to be impacted by the bond rate or what the equities market does, and I'm going to get my return, and I'm going to cash out my return. Yes, I have a tax consequence for that, but that is a stable, consistent, transparent, reliable return. So in these markets, where there's high inflation, where we're not quite sure what's going to happen geopolitically, where there's a lot of volatility around, an investor wants a safe haven for their money, but they also want the highest possible return. Now, as long as those conditions remain, there are always going to be investors to fund private credit.
Alan, thank you for talking to Fear and Greed.
Thank you so much for the opportunity, Sean.
That was Alan Greenstein, CEO and co-founder of Zagga. That's Zagga, Zagga, a supporter of this podcast. This is the Fear and Greed business interview. Remember, this is general information only, and you should seek professional advice before making investment decisions. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.